Don't look for the needle in the haystack. Just buy the haystack. John Bogle. Hello there, fellow investors. Have you ever wondered how to truly measure the success of your investments? Are you tired of simply chasing high returns without considering the risks involved? Well, you're in the right place. Today, we're diving deep into the world of portfolio performance measurement, and at the heart of it all, we have the Sharpe Ratio. Investing is not just about chasing dreams, it's about making informed decisions. And in this video, I'm going to equip you with a powerful tool, the Sharpe Ratio, which will ameliorate the way you evaluate investments. Whether you're a seasoned investor or just getting started, understanding the Sharpe Ratio is a game changer that will help you build a more secure financial future. Imagine this: you've got two investment opportunities on the table. One has delivered stellar returns, but the other is more conservative. How do you decide which one is right for you? That's where the Sharpe Ratio comes into play. It's like having a compass in the financial wilderness, guiding you towards investments that offer the best balance between returns and risk. In today's video, we're going to discover the Sharpe Ratio. We'll understand what it is, why it's crucial for your investments, and even critically examine what some academics have to say about it. But that's not all. Stick around because, by the end, you'll know how to calculate the Sharpe Ratio using real numbers in a practical example. So, whether you're managing your own portfolio or entrusting it to a professional, this video will equip you with the knowledge you need to make smart, informed investment decisions. Get ready to take your investment game to the next level. Let's dive right in. But before we delve into the details, if you're new here, don't forget to hit that subscribe button and ring the notification bell. That way, you'll never miss out on the latest insights and strategies for building wealth through investing. Now, let's get started. What is the Sharpe Ratio about? What is its importance and utility? Well, in simple words, the Sharpe Ratio measures the risk-adjusted return of an investment, and helps investors evaluate the return they receive for assuming a certain level of risk. It was introduced by the economist William Sharpe in 1966 as a result of his work on the capital asset pricing model, CAPM. The Sharpe Ratio is a widely used measure in finance that quantifies the risk-adjusted return of an investment. It helps investors evaluate the return they receive for assuming a certain level of risk. Importance of the Sharpe Ratio. The Sharpe Ratio is vital because it allows investors to compare different investment options on a risk-adjusted basis. It helps in making informed investment decisions by considering both return and risk. Utility of the Sharpe Ratio. The Sharpe Ratio is useful for portfolio allocation as it helps investors in diversifying their investments based on risk and return trade-offs. It is also a valuable tool for evaluating the performance of investment managers. Let's start by understanding the meaning of the Sharpe Ratio. The Sharpe Ratio is the ratio of excess return over the risk-free rate to the standard deviation of the investment's return. It measures the additional return earned for each unit of risk taken. We can calculate the Sharpe Ratio by subtracting the risk-free rate from the investment's average return, and dividing the result by the standard deviation of the investment's return. The interpretation of the Sharpe Ratio is that a higher ratio indicates better risk-adjusted performance, while a lower ratio suggests lower risk-adjusted performance. Now, let's explore the relationship between risk and return trade-off. Now, let's explore the risk and return trade-off in more detail. In finance, there is a positive relationship between risk and return. Investments with higher risk are expected to generate higher returns, while investments with lower risk tend to have lower returns. As investors, it is important to carefully evaluate the risk and return potential of different investment options before making investment decisions. This is where the Sharpe Ratio comes into play. It allows us to compare the risk-adjusted returns of different investments. Additionally, the risk-free rate serves as a benchmark for evaluating the excess return generated by an investment. Now, let's dive into the importance of the Sharpe Ratio. The Sharpe Ratio holds significant importance in the field of finance. It serves as a risk-adjusted performance measure for investments, providing a standardized way to evaluate different options by factoring in both risk and return. This is crucial for making informed investment decisions. The Sharpe ratio allows us to compare different investment options on a risk-adjusted basis, considering both return and risk. Now, let's explore the utility of the Sharpe ratio. The utility of the Sharpe ratio extends beyond individual investments. It plays a crucial role in portfolio allocation, enabling investors to assess the risk-adjusted returns of different assets. This helps in constructing well-balanced portfolios that achieve an optimal risk-return trade-off. The Sharpe ratio also provides insights into the benefits of diversification, highlighting the advantages of spreading investments across different assets. Additionally, it serves as a valuable tool for evaluating the performance of investment managers, helping investors assess whether the returns generated are sufficient considering the risk taken. Now, let's delve into the critique of the Sharpe ratio. While the Sharpe ratio is widely used, it is important to acknowledge its critique. The ratio assumes certain conditions, including a normal distribution of returns, constant volatility, and linear risk preferences, which may not hold true in real-world scenarios. Additionally, the Sharpe ratio has limitations, as it does not capture all aspects of risk and assumes that historical returns are indicative of future performance. However, there are alternative measures available, such as the Sortino ratio, which focuses on downside risk, and the Traynor ratio, which measures the excess return per unit of systematic risk. It is essential to consider these alternatives in addition to the Sharpe ratio. Now, let's dive into the academic critique of the ratio. From an academic perspective, there are further critiques of the Sharpe ratio. Returns of financial assets often deviate from the assumptions of the normal distribution, exhibiting skewness, kurtosis, and heavy tails. This poses challenges when applying the Sharpe ratio. Additionally, investors may have nonlinear risk preferences, with a stronger aversion to losses compared to preferences for gains. The linear risk preferences assumed in the Sharpe ratio do not capture these nonlinear preferences. It is vital for researchers and practitioners to consider these deviations and explore alternative approaches. Now, let's move on to the calculation of the Sharpe ratio. To calculate the Sharpe ratio, we need to consider three key components: the annualized return of the investment, the volatility of the investment's returns, and the risk-free rate. The annualized return represents the average return on the investment earned over a given period. The volatility measures the variability or dispersion of the investment's returns, indicating how much the returns fluctuate. The risk-free rate is the theoretical rate of return of an investment with zero risk, which serves as a benchmark for comparing the investment's performance. Let us now have a practical application of the Sharpe ratio, step by step. Imagine you're considering two different investment portfolios. Portfolio A is invested in a mix of stocks and bonds, while Portfolio B is all in stocks. Now, you want to determine which one offers a better risk-adjusted return. To calculate the Sharpe ratio, we'll need our three key pieces of information: the average annual return of the portfolio, the standard deviation of the portfolio's returns, and the risk-free rate, which we'll use as a benchmark. Step 1. Calculate the average annual return of each portfolio. For Portfolio A, let's say it delivered an average annual return of 10%, while Portfolio B achieved an average annual return of 15%. Step 2. Calculate the standard deviation of the annual returns for each portfolio. This measures the volatility or risk of the investments. For Portfolio A, the standard deviation is 12%, and for Portfolio B, it's 20%. Step 3. Determine the risk-free rate. Typically, we use the yield on a safe investment like a 10-year Treasury bond as our risk-free rate. Let's say it's 3%. Now, let's plug these numbers into the Sharpe ratio formula. Sharpe ratio, Portfolio A, equals 10% minus 3% all divided by 12%, equals 0.5833. And for Portfolio B, Sharpe ratio, Portfolio B, equals 15% minus 3% divided by 20% equals 0.6. So, there you have it. The Sharpe ratio for Portfolio A is approximately 0.5833, and for Portfolio B, it's 0.6. In practical terms, Portfolio B has a slightly higher Sharpe ratio, indicating that it offers better risk-adjusted returns compared to Portfolio A. However, keep in mind that the Sharpe ratio is just one tool in your investment toolbox. It doesn't provide a complete picture, so consider it alongside other factors when making investment decisions. Calculating the Sharpe ratio can help you assess the risk-return trade-off in your investments and make more informed decisions. Remember, the higher the Sharpe ratio, the better the risk-adjusted performance. That's it for our practical example. Now you have the skills to calculate the Sharpe ratio for your own investments. If you found this section helpful, please give it a thumbs up and let me know in the comments. And if you haven't already, don't forget to subscribe for more valuable insights into the world of finance and investing. The last, but not least point to discuss now is the Sharpe ratio applications. The ratio finds practical use in portfolio optimization and asset allocation. In portfolio optimization, the ratio is applied to assist in selecting and allocating investments within a portfolio. By considering the risk-adjusted returns of different assets, investors can construct portfolios that aim to maximize returns for a given level of risk. Furthermore, the Sharpe ratio aids in asset allocation strategies by comparing the ratios of different asset classes. This comparison allows investors to determine the optimal allocation of their investment capital across various asset types, achieving a balance between risk and return in their overall portfolio. And there we have it, folks, the Sharpe ratio demystified. We've covered a lot in this video, from understanding what the Sharpe ratio is to its importance, an academic critique, and a practical example of how to calculate it. But before we wrap things up, let's recap the key takeaways. First and foremost, the Sharpe ratio is your secret weapon when it comes to assessing the performance of your investments. It's like having a trusty GPS guiding you through the financial markets, helping you strike that delicate balance between risk and reward. Remember, the Sharpe ratio is just one tool in your financial toolkit. While it's a valuable metric, it's crucial to consider it alongside other factors, like your investment goals, time horizon, and risk tolerance. Investing isn't about blind optimism or chasing hot trends. It's about making informed decisions that align with your financial goals. The Sharpe ratio equips you with the ability to evaluate investments based on their risk-adjusted returns. We also delved into the academic critique of the Sharpe ratio. Some scholars argue that it makes assumptions about market behavior that may not always hold true. While it's essential to be aware of these criticisms, the Sharpe ratio remains a valuable tool in practice. In our practical example, we calculated the Sharpe ratio for 2 different portfolios, showing you step by step how to do it. Remember, practice makes perfect, so I encourage you to try calculating it for your own investments. Before we conclude, if you have any questions or want to share your experiences with the Sharpe ratio, please drop them in the comments section below. I'm here to help answer your queries and provide further insights. Lastly, I want to express my gratitude for joining me on this video to unravel the world of finance and investing. If you found this video valuable, please give it a thumbs up, share it with your fellow investors, and subscribe if you haven't already. Stay tuned for more exciting content on this channel. We'll explore advanced investment strategies, dissect financial theories, and keep you up to date with the latest trends in the financial world. Remember, the path to financial success is a journey, not a sprint. Keep learning, stay informed, and make those wise investment decisions. Until next time, happy investing.